Turner Novak is here, and he is a VC. If you're on Twitter and you're into VC Twitter, which is a full 0.7% of adult males in the United States, you obviously know who he is, and he's spicy. Is your screen okay? It looks like you're jittering a little bit there. You're on an M1 Mac, yes, of course?
No, I'm on a Asus ZenBook that I got for 50% off at Best Buy.
All right, hold on a second. You're a VC. You're showing up to meetings with a ZenBook.
Hey, it's all Zoom, so no one knows.
They know when your machine crashes like every 5 minutes and your video goes.
This Week in Startups is brought to you by Embroker's Startup Insurance Program helps startups secure the most important types of insurance at a lower cost and with less hassle. Save up to 20% off traditional insurance today at embroker.com/twist. While you're there, get an extra 10% off using offer code TWIST. Our Crowd helps you invest early in pre-IPO companies alongside professional VCs. If you're interested in investing, you can join Our Crowd for free at ourcrowd.com/twist. And Disruptive Advertising. Get $1,000 off your first month of service at disruptiveadvertising.com/twist.
Okay, and if you're listening to the podcast and wondering what the heck's going on here with the lack of formalities, we're trying something new. I'm just asking people, who are guests on the program, if they would consider going on live. When we go live, we use a piece of software called Restream. It sends a video stream to YouTube, Facebook, Twitter, Twitch, LinkedIn, which is kind of cool, Facebook, which I guess we don't get any viewers over there anymore. Well, it's interesting, Turner, when you build up an audience on these platforms, then at some point the platform's like, we'll just take that audience back and then charge you for it. So Facebook, I have like zillions of followers, 100,000 people following the page, whatever. And like 3 people get a notification about the video. And they're just like, would you like to promote this? I'm like, no, I want to reach the original audience that you convinced me to build for 5 years and whatever.
You know what fixes this?
What fixes that? Crypto?
Yeah, Web3. Have you heard of it before? Have you looked into it?
I have. All right, listen, let me just give a brief overview of who Turner Novak is. You can follow him at Turner Novak on Twitter. He gained massive popularity over the past couple of years in his full 30 months as a VC. Just basically turned ish posting into a fund. His fund is called Banana Capital, and he's quite spicy on the Twitter. Turner, how did you get into venture?
It's a very long story, but essentially,
it's a podcast, so we have time.
Yeah, I mean, how much do you want? Do you want the 30 second? Do you want the 30 minutes or somewhere in between?
Yeah, the in between, whatever you choose.
In between.
So you wanted to get into VC, but when you were younger, or when you couldn't get in?
I guess the kind of the minute context. Originally from Canada, moved to the US. My parents got divorced. Dad moved back to Canada. Mom went back to school to get a visa, stay in the country. Couldn't really work. So volunteer under the table, get paid cash gift cards, got food from the food bank growing up. She also had a small business. She designs custom handmade wedding gowns, which is a decent business if you're in New York, Paris. Not the best business if you're in a small city in the Midwest. And I just spent a ton of time on the internet as a kid, got kicked off the computers at school every year. That kind of an upbringing, and just knew I'd do something kind of tech related, but went to school for accounting and finance, joined the investment club in college, and was holy crap, you buy a stock and it goes up.
Yeah, stocks
investing.
Go up.
Yeah, they don't go down. They only go up. Like investing, this is awesome. I want to be an investor. And I just kind of went down that rabbit hole where, you can invest.
Were you in college? I'm curious, just to pin it to the stock market.
Yeah, 2009 through 2014, I did a victory lap. My last 3 years, I cut down. I just did a bunch of internships to make money and avoid student loans. And so I would look at a company like Uber, like it's worth $100 billion publicly traded, but why can I invest in Uber when it was worth like $1 billion? Or there's some people that were like the first investors at Uber. Like, I want to do that.
Whatever. Yeah, you want to do that.
Yeah, third or fourth, like fifth, I don't know. But anyway, so
you became at some point aware of private companies. Do you remember how you became aware of private companies? You're just reading like TechCrunch or something?
Yeah, honestly, I don't remember specifically. I mean, I think it was probably around the Facebook IPO, the Twitter IPO. I'd watch the opening bell with my roommates and be like, oh man, I remember the Twitter IPO. It took like 6 hours. Like it didn't go public until like 2 p.m. We like skipped class. And I just remember thinking like, maybe not Twitter specifically, but like Facebook, what a great business. Like, why would I invest in the IPO? Like, why can't I just invest before? Like, how do I set myself up to go earlier? And that was a long process of figuring all that out and being in probably the third best city in Michigan to get into tech in VC. Like, it was a long process, but yeah, just essentially I just got some jobs related to investing and kind of more finance related in Michigan, started writing online a lot, just picked some topics to write about that I thought would be worth kind of like planting the flag, building a track record around. I did this fantasy VC portfolio. It's like fantasy football, but with startups.
Oh, nice.
And initially my Twitter was probably 99% serious back in the day. And now it's like 1% serious, 99% just memes.
Twitter's for joking, trolling. I mean, you get a lot more attention from that. But just to confirm, instead of going to class, you decided to cut class. And instead of deciding to cut class to go hang out with chicks or to go drink beer or to go to the quad and smoke weed, you and your dork friends went to watch CNBC and watch the Twitter IPO.
I would like to think I was a lot cooler than that, but yeah,
I think it's the ultimate nerd move. It's pretty great, actually. So you're writing online, you get a little bit of attention, but then you want to start your own fund. And how old are you at this time that you decide you're going to start your own fund? Because that's the kind of new thing that's occurred here is that young people actually believe they can start their own funds and they actually succeed, which just didn't even seem like a possibility, I'll be honest, 10 years ago.
It's stupid. I don't know why you even try it, to be honest. It was kind of an accident. I mean, I had been essentially trying to prove I could be a VC from Michigan, which essentially meant being online instead of in San Francisco. And this was early 2019 was when I finally got all the interviews and everyone was like, you got to move to San Francisco. You can't be a VC unless you're here.
No.
Which made sense at the time. But when I think about like my advantage, like if you're a startup, you got to think, how do you attack the incumbents? I was like, how do I compete against the incumbent VCs or just like the people who are, probably like a shoe-in to get the jobs? I'm the complete opposite kind of background and network that I have set up. So I was just like, I don't think I need to be in San Francisco. So yeah, I just tried to figure out how to make it work. And I took an internship. It's like a pretty big pay cut. And I actually had to sell my house because I couldn't afford my mortgage. And then we had a rental property that you can buy real estate in Michigan for like $65,000. So I sold it because I had a ton of equity in it and we had to move. So we just moved right next to my in-laws instead of in Ann Arbor on the other side of the state, instead of moving to San Francisco. And then pandemic hit. As I joined this real estate firm called Gelt, and they were like, hey, let's raise a venture fund for our real estate LPs. And with the pandemic, COVID, they were really focused on the real estate business. It was tough to get LPs to come in. And I just had a bunch of people that were like, Turner, we've been co-investing together. Like, if you ever start your own fund, like, I'm in. Like, I had a bunch of money kind of soft committed for this fund that I actually wasn't going out to try to do. But I just hit a point where everyone was like, yo, you gotta do this. Like, I think you'd be good. And I thought, maybe in 20 years, I'd launch my own firm. I think that's what I told
pay your dues.
That's what I told my wife the first date that we had. I was like, what do you want to do? I was like, I want to be an investor. I want to run my own firm one day. And I was like 23 at the time. I think I'm 30 right now. Started raising this right before I turned 30 in January was officially when I was like, okay, I have to do something. And I just kind of went back to all the people that I'd been talking to, meeting, co-investing with, all the founders I'd backed, and told people what was happening, and everybody wanted to invest. So, and it was my thesis was I can use memes to get distribution online, and it's way more efficient than anything else. And it was while GameStop was happening, and that was not a tough sell at the time. Like, everyone was like, oh, memes, duh. Like, this makes sense. Right. So just really lucky timing with how COVID, the pandemic happened, how memes have kind of blown up. It just all kind of worked in my favor. So yeah, super lucky.
If you don't have business insurance, you failed one of the first steps of being a great founder. Startups should look no further than Embroker. Embroker's technology saves you time and money. Prices are like up to 20% lower. And they got better coverage than all these slow incumbents. You can go from sign up to quote and purchase in just 10 minutes. I kid you not. And when you work with Embroker instead of business insurance incumbents, you're not dealing with large, slow corporations. The sign up takes days, not weeks, and the process is so transparent. There's no opaque pricing. There's no negotiation. You just get it all done. Easy peasy, lemon squeezy. I'm going to quickly explain to you one crucial type of startup insurance that Embroker covers. It's called E&O. You may have heard it or overheard it. It covers errors and omissions. That'll help you deal with scaling your business. And because any major customer you try to sign up is going to say, hey, can you show us your E&O? Part of the diligence process. So you want to get it now. It's not that expensive. These things are part of the process of growing up as a startup. And you know what? I find sometimes people wait until they get burned to put on their insurance. The insurance is not that expensive. You want to do it proactively, especially if you've raised money recently. That's the perfect time to deploy a little bit of capital into protecting the kingdom, protect your enterprise. So to instantly buy custom-built insurance for startups, go to embroker.com/twist. And while you're there, you get 10% off their already amazing prices by using the offer code TWIST, T-W-I-S-T, Embroker, EMBROKER.com/twist. All right. Thanks for supporting the show, Embroker. Love you guys. And you decide to raise like a $10 million $10 million fund based on this meme action. You start, and this is kind of like how open the industry is because of Twitter, Clubhouse, other social platforms, previously blogs, obviously podcasts, getting into VC, literally interacting with the top VCs requires mastering Twitter, which requires arguably 100 hours of being on Twitter, maybe, if you do it thoughtfully and just copy the people who are doing interesting things or being, let's just say, reasonably good at the Twitter.
Yeah.
You just slide into everybody's replies. You start doing funny stuff. Obviously, I see it. You're trolling me. You're mixing it up with somebody else. And it's like, okay, of course I'm going to respond. You're talking about me. I have no choice. I'm at least going to like it. I have a sense of humor. But you must have gotten blocked. Did you go over the line with some of these memes? Did you, piss people off? Because when you're doing comedy, it's a fine line. Like the joke and the hurt could be right next to each other.
Yeah, there's definitely... It's funny enough. It's a lot of public market hedge fund anonymous Twitter accounts that don't like it. You probably know the exact archetype I'm talking about.
Yeah.
They're just probably not the funnest people to hang around anyways. I think most VCs, they kind of we all kind of acknowledge yeah, we are kind of a meme. We are kind of pretty easy to make fun of. And I think it's
pretty easy to make fun of. Yeah. It's like, who are these affluent D-bags who just write checks and then take credit for all their portfolio company's success? And what is that job even doing? You listen to a pitch and you say yes. It's like, okay, you wrote a check.
Yeah.
Congratulations, you're an ATM. I always tell people, don't forget, you're an ATM. People are not talking to you because of your personality. They want a check. They want money to fulfill their dreams. And sometimes maybe on the margins you can help them with some stuff. But you didn't go fly so close to the sun that you burned any relationships that you can think of. Who's got the least sense of humor? Who's got the least sense of humor that was blocked you or something? Certainly Mark Andreessen's blocked you for sure.
No, he actually hasn't. He's retweeted a couple of the memes.
You got work to do.
Yeah, I love A16Z. They're awesome. I think the strategy that they're trying to execute on, there's all these different, if you think about venture firms and you pick a strategy, it's just like companies. The one that they're executing on, it's working. I think they're really good at what they do. And there's other lanes to compete on. And so, yeah, I have a ton of respect for them. I think they've done a really good job.
So tell me about mechanically, for the benefit, obviously I know of raised funds, but for the benefit of the audience, there's people who are watching who are 22 years old or they're 19-year-old Turner Novaks in college watching this. And they're okay, yeah, he did it at 29-30. I'd like to do it at 24-25. How does it work to, raise a micro fund, this $10 million, my first fund kind of situation? My first fund was $10 million in fact as well. And I just passed the hat 10 years ago at a poker table with a bunch of my besties. That's how I did it. Didn't do it over Twitter, but your technique over Twitter seems a lot more efficient.
Yeah, honestly, it was, so initially, it was a pipe dream. Thought it might take a really long time. And it was just trying to build a track record and trust, because there's people who want you to be a fiduciary of their capital and get a return. And there's other people, if you're a VC, and if you're raising a small fund, they want you for deal flow. It's almost be a scout for me. $50K. Tell me when your best portfolio company is raising a Series A or a Series B. I want to lead the round with a $20 million check. So those are kind of the spectrum of the people. It's
That's a new dynamic in the industry, which is Mark Andreessen did that in my first fund. A bunch of venture firms were in my first fund. You have Sequoia Capital in yours. I was the first outside venture fund that Sequoia backed, actually with launch back in that first one. And that's a new phenomenon. Mark Andreessen did this as a way to sort of spread influence. He put $50K into a bunch of funds. I subsequently kicked him out of my second fund. Well, he wouldn't speak. He wouldn't come on the podcast. And he wouldn't come to the event. So like do a fireside chat. And I was like, he's like, in order for us to like be in business together, do I have to like be on your podcast or come to an event? And I said, yes. And he said, okay. And I said, great. Just, that was the end of the relationship, basically. Well, I just thought it was like a jerk move. Like you want to support me or you don't want to support me, like pick one, Mark. Like, and then you block me and unblock me and email me and then not email me. And then, want to buy my superhuman shares from me. And, I was just like, no, I'm not selling you my superhuman shares. Like, but this is a new phenomenon of venture firms wanting to use you as an early signal. So how many venture firms are in, or partners in venture firms are in your fund? Approximately a dozen?
It's a pretty big number. Venture firms and partners, probably like 50 or so.
Wow. If they put in 100K each, that'd be 5 million. So if on average they hit 100 or 50, it's 2.5 to 5 million, something like that.
Yeah, it was probably about 75 on average.
Yeah, that makes sense.
Yeah.
So that's amazing. Now you have 50 of them. You have a portfolio company that's breaking out. How do you communicate that to 50 people? Because they all want to lead the A. So you just do a BCC, or do they just read your LP update? Like, hey, here's what we invested in. And then they just look at the spreadsheet, or do you give them a spreadsheet and say, hey, here's what we're investing in, so they can double click on it, and it's up to them to go drill down and ask for the introduction?
Yeah, I think that's the art of it, right? Like you want to keep all these kind of downstream or upstream, I guess, depending on how you think about it, investors.
Downstream's the way
I
think of it. Yeah.
Yeah.
So the way I think of the downstream thing, just so people understand the metaphor, what we're talking about here is downstream investors. So if Turner and I are at the well, YC's at the well, you're just watching, the water come out of the well, the spring, it goes downstream, and then seed funds that do $3 or $4 million checks and venture funds that do $10, $20 million checks would be downstream from us. Downstream from the Series A funds would, of course, be the late stage funds.
Yep. Yeah. So it's essentially you just try to have a good relationship with all of them, and you kind of know what people like. Like some people, sure. I invest in kind of tilts consumer. There's a little bit of more like software stuff, and I just kind of know this guy's not going to like this thing. Don't have to mention it to him. But you just kind of balance it, and I think ultimately you take what the founder wants ahead of everything.
Sure.
Like you might say, hey, just a heads up, these guys are raising money. He's not taking any intros, but you can reach out if you want. And I'll just tell the founders like, hey, I mentioned to some people, these guys might reach out. You don't have to reply, but you probably should with these guys, so it's a spectrum. You just try to balance it. It's like a relationship thing.
How far into the 10 million deployment are you?
So of the fund, we have invested, it's probably like 55, 60%. And through SPVs kind of total, it's like 25 million.
Oh, so you're doing the
like
fund plus
million-ish.
SPV model, which is the model I did or pioneered. Yeah.
Yeah.
So
and it was
explain to the audience how that works.
Yeah. So the fund is essentially 25K to 300K checks. Try to have a balanced portfolio. I basically pitched people, there's going to be 40 to 50 companies. Nothing is going to be tilted and weighted really heavily in the fund. And there's some cases where we'll put $1 million, 1.2 million in a seed, or 5 million in a B, or 10 million in a Series D. And that can't fit in the fund. So we'll have invested in those companies earlier in the fund, but then when they follow on and break out, we'll go to all the LPs. And there are some people who don't want to do SPVs. They're like, I don't want to pay fees. Like I want to invest direct, or I want to lead the round. But there's a lot of people that are just like high net worth, have a lot of money that are like, hey, let me know. I can't do 100K checks, but let me know when we can do 1 million or 5 million in SPV and we're interested. And so you kind of use those to augment the fund. I actually do not like the SPV process. I think it's a hassle raising the money. It's just like, it takes a lot of, you have to convince people
6 weeks.
You
have to pass the hat. You have to write a deal memo.
Which doing diligence, like who does diligence?
I do massively. I do absurd diligence for an early stage fund.
Yeah.
No, you don't.
I don't sleep usually. I just do diligence all night.
Team. I have 18 people. I mean, you have, but this is the big challenge. When I first had my fund, which I had no people, I had an executive assistant at the time, who then became my chief of staff. But you have a $10 million fund. even if you were taking fees on it, I didn't take fees on my first fund, but if you did take fees, 2.5% a year is $250K. That's basically enough to pay yourself. So how do you staff one of these funds, or do you just not staff it? And you just, that's kind of part of the issue here is like you're writing 50 to 300K checks. You're not going to have to read the legal documents. You're kind of going along for the ride. You're not going to be doing the diligence. You're just going to get to know the founder, and everybody kind of understands that at this early stage.
Yeah. I think it depends. So my pitch to my investors and the founders that I back is there's all these hedge funds that are coming down from the public markets and they're going earlier and earlier. My long-term vision is do the exact opposite, start at pre-seed, but eventually invest in the public markets. And to the founders, it's like, okay, so you have like the DNA to actually like understand what I'm doing and like maybe work with me a little bit earlier on. Like I don't pitch a value add at all. I'm just like, I'm a dude. I'm not going to help you grow your business, but can maybe understand the product maybe a little bit better than a later stage hedge fund that's coming in. And
which is Sequoia's point with the new Sequoia fund. Yep. Sequoia saying, hey, listen, I'm rule off both. I've been on the board of Square forever. And why would I leave the board? And when it went public, it was $15 or $20 a share. It's now $200 a share. We're going to distribute late and we're going to hold our shares forever. The end. And I think they were also in DoorDash. Alfred Lin did DoorDash. And, they're just staying on those. And, according to them, they don't distribute their shares to their LPs until they think it's fully realized or, maybe in the public markets for 2 or 3 years. And now they're saying, hey, we're just going to hold these equities because they're sitting on $45 billion in equities that they have. So they're going to become, everything seems to be hold everything forever. All around the world, tech companies are innovating and driving returns for investors while our crowd analyzes many of these companies. They search across the global private market. Then they select the ones with the greatest growth potential. And finally, they bring them to you and me. From personalized medicine to cybersecurity to robotics to quantum computing and much, much more. Whether it's in a state-of-the-art lab, a startup garage, or anywhere in between, our crowd identifies innovators so you can invest when growth potential is greatest. And that's early. Don't I know it? Our crowd's accredited investors have already invested over $1 billion in growing tech companies, and many of their members have benefited from 46 IPOs or exits. Now you can truly diversify your portfolio by investing early in innovative private market companies at Our Crowd. Join the fastest growing venture capital investment community in the world at ourcrowd.com/twist. That's OurCrowd, OurCrowd.com/twist to sign up for free today and start reading all those great deal memos. Have you hit, it's been pretty crazy days here. 2 questions. One, how do you think as a neophyte investor, first-time investor who's only operated at the top of a market. You've only operated at the top of the market. And in fact, you started your career monitoring all this right after the last crash. 2008 was the last crash. So you've only been an adult in an up market.
Yeah.
Basically, stonks have only gone up for you. And valuations, consequently, you're probably seeing this as well. $25, $50 million, even an occasional $100 million pre-launch valuation, pre-product market fit, pre-launch valuation. How do you think about these crazy valuations and having not lived through the wars, Clone Wars or the Empire? Yeah, those are Star Wars references. It was like Harry Potter, but before that.
Hey, cool. I'll look it up after this.
Yeah.
It's kind of a loaded question. There's a lot to unpack. I think.
Yeah, unpack.
Ultimately, I don't expect any multiple expansion on any investment that I make. Probably expect some multiple contraction, and that could be on revenue, users, hype, whatever multiple you're paying. So I think anytime I make an investment, the value has come from actual execution and just like growing and like making a fundamentally like sound business that is eventually a publicly traded company. And I think if you invest in a seed round and it goes public in 10 years, you might get a 20x, you might get a 100x, but you'll make money. So I don't get too worked up about the exact nuances of it, especially for this fund. I think any check that's like $100,000, $150 can return a $10 million fund. You're not leading round. So the way I kind of approach it right now is you're really just trying to find the best founders and products and companies and teams and just back them and you're kind of building a track record. In the future, you have to be a little bit more sensitive about what the ownership looks like and, look what the valuations are. I have backed out a round, which is like, I just think this valuation's kind of crazy, don't have a lot of conviction in it, et cetera. So you kind of
is kind of interesting. You're taking the valuation and your conviction, and you're taking those two vectors and saying, hey, I'm high conviction. And then this is how delighted I am with the valuation if you put it on an XY. Obviously, if you think it's a reasonable valuation, reasonable, unreasonable, you can kind of plot on an XY chart. If it's a reasonable valuation and you have high conviction, you're pulling the trigger. Reasonable value, even like unreasonable valuation, high conviction, you might actually pull the trigger, right?
Yeah.
You're going to give them credit for their Series B essentially at the seed round.
Yeah, I really don't think that's happened. So
well,
maybe
Clubhouse was $100 million, and that was the Series B price previously.
And I thought it was kind of crazy. I didn't have enough conviction in Clubhouse. I didn't even really try to invest. Couldn't have.
I tried a couple of times, but Marc Andreessen was in it, and as I previously mentioned, we have a little bit of a unique
you got to work on that relationship. He's the man.
No, I just think that's one of the things about being early is you answer to nobody. If you're willing to do the work, think about how painful our job is being the earliest investors. We have to have conviction when the product maybe hasn't even touched consumers yet, or there's 10 customers, right? How do you make decisions? Do you actually talk to customers at this point? Do you look at data? Or do you just look at the product and get to know the founder and that's enough for you?
For me, it's a mix of everything. I think data is always helpful. You want to be able to benchmark it. But the thing is, I think like the sweet spot is decent data. Like there's some promise. There's a lot that could be better. And you can just tell based on playing with the product and talking to the founder, like, oh, the data is going to look way better in the future. They're going to make the metrics look better. And the valuation is very fair because of that. Like it all reflects it. And you have the conviction that, they'll easily be able to hire some engineers to just go a little bit faster. And like, they just need the money and they'll execute on all these things that need to happen to kind of close all this and pick all this low hanging fruit that they still need to do. So that's almost like the sweet spot that I try to look for is like, there's some proof point, there's some traction. There's still some questions, and that's typically when it's a like seed. When it's like a Series B.
Most things haven't been figured out, but something promising has emerged. Is if I'm reflecting back to you what you're saying.
Yeah, it depends on stage. Like I've done some pre-seed. It's like pre-launch. The founder's 20 years old, has never started a company before, but you can just tell based on the conversation. Like you pull out all these things she's done throughout her life, and you're like, okay, I should probably make the bet now. Because I will regret not doing it. Because it just feels like she's probably going to keep doing all these impressive things, but it will now be through her company instead of, running tuition or running tutoring classes in high school and like getting into a good college from like a bad background and like all the stuff that she's done. So you kind of try to find those. There's like the famous thing saying it's like you invest in lines, not dots. So you kind of, if there's no lines, you try to like go backwards and like produce the lines that happened before you met the founder and like, or before they even have any actual data or progress on their company. And then when it's like Series B, C, typically for me, it's more of, like, do I feel like my spreadsheet is going to be way like the market size in my spreadsheet can be 10 or 100 times bigger than how everyone else is thinking about it. Like, oh, this boring, this lame consumer app actually has like, 100 times more people could potentially use this based on some new features they're adding down the pipeline, and 20 times subscription revenue is actually a fair valuation because of all these things that they'll do. And again, it's super contextual, very nuanced. It's not like a one sentence kind of answer, but you kind of try to think about all these things. And I kind of try to back into like, do I think this founder is going to build a publicly traded company? That's ultimately what I try to find. And, you try to look for like comps, like, oh, there's this big, dumb legacy 100-old company that does 50 billion in revenue, and like their executives print their emails to read them, or like they still use faxes. So it's an interesting company to compete against if you're a tech startup. So you just try to find like all these different little things to kind of piece together. And like, honestly, I don't go out and try to invest in like, this is a slam dunk home run, super obvious to everyone. That's generally not what I'm investing in unless I have some kind of unique edge in, and like the founder really likes me.
The things that are consensus generally exist in the world already, or are so obvious they've probably been tried already and people have failed. It's the non-consensus bets. You know, Airbnb famously pitched 37 venture firms before they got a yes. At the Open Angel Forum, when Travis presented Uber, 3 of us invested and 19 didn't. Mark Suster wrote a famous blog post about not investing.
Wow.
And so, you know, and I introduced Tesla to dozens of venture capitalists and, you know, just email friends like, hey, you know, you should take a look at this. And they were like, our company? Are you crazy?
Did you invest?
I didn't. I wasn't an angel investor at the time. People always ask me that. And it's like, I wasn't an angel investor, but Elon was raising money. And I just emailed a bunch of friends and that's actually how I wound up becoming a scout at Sequoia, was I had emailed them and said, hey, you know, I know you know Elon really well. Like, he's making progress on this. I just drove in the prototype. I ordered one. Like, this is going to be incredible. And then I emailed Twitter and I was like, Michael Moritz and Roloff, you just have to do this deal. It doesn't matter that Fred Wilson is overbidding. Like, and I had been talking to the Twitter folks, and they were asking me, hey, what do you think of you've got backing from Sequoia? That's all be in my autobiography at some point. And Fred Wilson was doing the deal, and Evan was like, hey, what do you think of Fred? Because I know you're friends with Fred, and Fred's wife used to work for him. And I was like, Fred's the nuts. He's amazing, like East Coast VC. But, you know, and back then East Coast VC was kind of a negative signal. And he's like, and what do you think of Sequoia? And I was like, well, you know, honestly, like Sequoia, you can't go, you know, Sequoia versus Fred Wilson. Like, if you were in New York, I'd say go Fred Wilson. If you're in the West Coast, maybe it's Sequoia. Like, this is like picking between like 2 of the best options. And Sequoia didn't close the deal and Fred did. Sequoia didn't do Tesla. And then I told them to do my friend's poker app, which eventually became Zynga, but it was online poker. Wow. So all 3 of those they passed on. And then they were like, can we just give you money and you invest it? And I did Uber, Thumbtack, and DataStax in my first 6 or 7 investments. So 3 unicorns in the first 7. And that's basically the serendipity of how my career started. Was I had been forwarding so many founders, and that really is like your story as well. Have Apple's new privacy updates impacted your attribution from paid ads? I bet it has. Well, good news. The folks at Disruptive Advertising can help you. Disruptive Advertising manages over $250 million a year in advertising spend, and they are trusted by hundreds of brands like Adobe and Scotts Miracle-Gro. So, if your Google and Facebook ads are not scaling like they used to, you should do a consultation with Disruptive. They will look to help you scale your spend profitably. How? By diversifying your ad strategy on less popular platforms. They'll track every single dollar that you spend or earn, and their marketing consultants focus on end-to-end tracking across your CRM, marketing automations, and e-commerce platform. They care less about return on spend. What they really focus on is contribution margin, profitability, and closed deals. So here is your call to action. Get $1,000 off your first month of service at disruptiveadvertising.com/twist. Disruptiveadvertising.com/twist for $1,000 off. Just start doing the job, and then somebody will give you the job.
Yeah, exactly.
This is like such an easy concept that a bunch of crybaby snowflake peers of yours do not understand. So explain to me why it is so obvious to you that if you just do work in the world that is credible and that is in the vector and the sector that you want to perform in, then everything just falls into place. And you said it yourself, like, you're like, hey, listen, if this founder, if she's done a bunch of stuff and she is entrepreneurial and she, you know, worked on this project and it took grit, and you're just putting together all those dots and then making a bet. What's going on with your generation? You're Gen Z, correct? Or are you millennial? Are you bubble? Are you bubble? Okay, so
I'm millennial, yeah.
So with these millennials, there's a lot of crying. There's a lot of emotions. There's emotional labor going on, from what I understand from one of Rachel Reporting's OK Boomer segments, Fridays on This Week in Startups. Why are your contemporaries so caught up in their goddamn feelings as opposed to simply posting on Twitter like you did for 6 months and then raising your own fund? I mean, it's such an obvious path. If you just do the work, even if you're not getting paid, you will then get the job. What's going on with your generation? You represent now all millennials. Go.
Yeah,
Speak
I don't know.
For your generation.
This is a hard question. I guess I just kind of like, I saw it as, well, I probably wouldn't hire myself. So what do I have to do to convince myself to hire myself? Well, because I like knew in my head, I was like, oh, I could be so good at this. Yes. I think those are like all the skill sets I have. I just, like, how does someone else know that? So I just kind of started writing online and tweeting. And it was more serious stuff back in the day. It was like, you probably know like the thread emoji. The thread emoji did not exist on Twitter like a couple of years ago, but that's like the kind of stuff I would do and just try to like build a public track record of just my thoughts on stuff, and hopefully I'd be proven correct in the future. And so, like I think, and that's hard to do. I mean, I think it's actually hard to come out and say right now, like Web3 is like a terrible idea, like it's going to fail. Like that'd be very contrarian to say right now, or to come out and say like, San Francisco is the future. You got to move to San Francisco. Here's all these reasons why. Like you basically pick stuff that other people are not talking about. But then when there'll be some people that read it and it's like, oh, this guy's dumb, has no idea what he's talking about. There'll be some people who are going to go like, oh, that's a good point. Like
interesting,
maybe he could,
point of view.
Yeah, he could bring a good perspective. And then over time, San Francisco comes back. And everyone's like, oh, Turner was like on this. He knew that San Francisco would be a thing, or like he was all about Miami and Austin before everyone moved there. So,
or if you bet on Airbnb or you bet on Uber when nobody else did, you just all of a sudden get some disproportionate amount of credit for the founder and their team crushing it, right? It's like, oh, you know what? You saw it before everybody else. And it's like, well, I actually placed, 16 bets as a Sequoia Scout, I think 700K total and 16 bets. And like 5 of them, became worth over 100 million famously. But like that is the model decent in what we do. It worked out okay. It's one of the things about starting in an up market. I started 11 years ago, so you start in 2009, 2010, you get this huge bet. I'm very realistic about that. When I went out and raised my previous funds, I was like, I can guarantee you one thing. My IRR from the Sequoia Scouts fund and going forward, like it's only going down. You can't maintain 109% IRR, or 109 IRR. Like that's just impossible. That's just luck, and a small number of investments, going very big. But I think it's important for people to hear. Listen, I don't want to get into generational war, but I do think it's an important note because Gen Xers, when we came out, we were like, listen, we're not part of the system. Therefore, we have to make our own system. And we were very entrepreneurial in that way and was like, you know what? We're going to be rebels. We're going to come at it from a little bit of a punk rock, alternative kind of approach here, which is, we may, be moody or whatever, but we're going to build it for ourselves. And then millennials came along and it kind of like bifurcated because I meet a lot of millennials who are like you, who seem like I'm not employable. So F it, I'm going to just build my own, I'm going to take my own course here. I'm going to chart my own course. I'm not going to just go up the ladder and wait in line. But then there's a bunch of them who seem paralyzed and like the system is so rigged, it's so unfair. What do you think now that you're in business a lot and you were outside of Silicon Valley? Do you think it's a closed ecosystem or an open ecosystem? Having experience around it. I mean, we're touching the third rail here, but let's be honest about it.
Yeah. Open or closed in what sense?
New people being able to incorporate themselves into it. Accessibility to new voices, new people. Openness to accepting young, new people.
I think it's very open. Honestly, I think it just depends, though. Like to certain, you need the right kind of mentality and things that you bring to the table, and there's a lot of things that are probably wrong with how it works, and I do try my best to fight against those and give like certain people a voice. But I think if you ultimately, I think there's like I think at the end of the day, the startup ecosystem, people are trying to make a big impact in the world, trying to make money. So if you can do those things, bring a new perspective in, like people will value your perspective, right? Like they don't know, like meeting you 20 years ago, who would have known that you would have been the guy who sourced Tesla, Uber? Like if they would have just, brushed you off, they wouldn't have gotten access to all those things. But if they would have just taken the one call, got coffee with you, they're the one person who did that for you. You'll love them forever. And they'll like,
that's why they're Sequoia.
Yeah. So I think it's fairly open. I think a lot of people are very busy though. So if you just say, hey, I want to pick your brain, like
not the right way to break into the system. But if you say, I'm going to write, I'm going to do a podcast, I'm going to make funny TikToks.
Like I bring something to the table.
I'm going to bring something to the table. You're going to prove something. You're going to show some work.
Yep. Yeah. It's like with investors investing in startups, I don't think anyone invests pre-traction or some kind of proof points. Like there's a lot of these pre-launch seed rounds. the founding team has a huge history. Like, you don't need
the three of them worked together at Facebook and built some, mobile ad technology that has 7 patents. And they're like, yeah, no, we invested pre-launch. And it's like, in 3 people with 4 patents each, like, okay, great.
So I think it's like
risk you took there.
Yeah. So I think it's just like everybody's looking for just like new information or meeting new people. And, I think there's always like some proof points that you can show. Like,
I have a theory about it. My theory is the industry was so closed and it was all MBAs and Stanford and Harvard MBAs. And to get in a seat in a VC firm was extremely hard. You had to know somebody, be a frat brother, and even then, it was hard. There were only a limited number of seats, right? Then you had this like angel investor thing, which when I started 11 years ago, like I had a hard time finding 6 or 7 angel investors in Silicon Valley. Like the demo days, like, 10 years ago, it was me, Cyan, Chris Sacca, it was just, Ron Conway. There was a very small group of people angel investing. And, the 20 people, 30 people that you could round up for a dinner to look at companies when I did Open Angel Forum was just so small. But it was enough to get 250 or 500K, $1 million, passing the hat 25K at a time, that it did work. But I think there's an overhang between what was true in 2000, which is it is a closed system, and you're probably going to be a white guy out of Stanford or Harvard if you're going to get this job. And then 2021, which is if you want to start being a VC, you can just be an advisor, or you can pop up an SPV, or you can pop up a fund on AngelList, Carta, Assure. Like all these services didn't even exist. I give a lot of credit to Naval and AngelList and Assure Fund Management and Carta. Well, they kind of were a fast follower, but really AngelList and Assure opened the world's eyes to like, JCal could have a syndicate, and Tim Ferriss, myself, and Kevin Rose were the top 3, and Gil Pencino were the top 4 syndicates on AngelList. And it was like,
really?
Yeah. Well, Naval awesome. Launched it, and the 4 of us were on there. And then Tim Ferriss and Kevin Rose with their followings had $5 million in commitments and like 1,000 people. And then Gil and I had like 100 or 200 people and like, 300K in commitments. But those guys never syndicated deals because they were too busy doing other things. And Gil and I actually just hustled and grew, and we actually did a lot of deals together.
I feel like that's very impressive 10 years ago or whatever versus now. To your one point though about the cycle, I do think about it a lot. So what I focused on quite a bit is I'm trying to get very institutional LPs that are in it for the long haul. All my communication with them is, it's kind of insane. I'm doing really well on paper. Like it doesn't mean anything. I'm just trying to lay the proof points and lay the foundation to actually do this for a very long time. And hopefully over a long period of time, be a good partner to you guys. And, for 10 funds or however long it takes. And my expectations are always fairly low around the, I do think we're closer to the top than the bottom. So I'm going to act like that. I don't know.
Actually, what I'm doing right now as a strategy is, we invested in 350 companies in the last 11 years. Over 200 of them are, I would say, vibrant and active. Other ones have exited or, are kind of sideways or whatever, maybe zombie mode or, eventually going to be shut down. The founders just haven't, put the final nail in the coffin. I have 50 to 60 of them raising money concurrently the last 6 months. So every week, 3 or 4 of them close around, and then 3 or 4 more start around the next week. So literally, I just took the team and I was like, can we just focus on our portfolio that's raising money, doing our pro rata? We'll still do, primary investments and syndicate investments, whatever other things, but let's just make sure that our companies get cashed up at this high valuations, high market. Let's make sure they have all the dry powder they need to succeed in their missions. And it's given me the ability to be like, I'm going to say no on, I'm getting invited to crypto rounds, and I find the idea and the team's credible, right? So that's actually a big, and we should talk about crypto, but that was a big turning point for me because it was just like all these like shysters and like really smarmy people who were like, I knew them from the .com era, who were just clowns during the .com era, and they're just like, now they're billionaires in the crypto era. And I'm like, okay, you're writing a white paper with spelling errors in it, and you're raising $100 million ICO, and you're going to destroy Airbnb with a token? That's not gonna what are you gonna do? Take the tokens and like throw them at the Airbnb employees and like
break the windows and
break the windows? It's not gonna work. Like Airbnb's got network effects. Like why is a host gonna want tokens instead of cash? They don't pay it was just the whole thing was so stupid. But now, like I'm actually seeing some credible teams, and they're like, yeah, Solana's already built. This is already built. This is already built. So here's what we're doing. We're building it down. Here's how it works. It's in an LLC. It's legal. We got this. Goodwin Procter figured this out. Wilson, and I'm like, okay, you're not a criminal. They're like, no, you know me from these 3 other startups. And I'm like, oh, okay, that's true. I do. You're legit. Oh, you have 4 developers. Okay, so there's 4 full-time developers working on this, not like maybe some developers who are doing this on the weekends. What are your thoughts on crypto in 2021? Are you investing in it actively, or are you just dunking on it on Twitter, or both?
Yeah, both. So I think there's there's a couple interesting things about it. I do think it's just like my Twitter is just like poking fun of the stuff that we're all kind of thinking about and like no one else is saying. And there's a lot of people talking about crypto and Web3, so I'll poke fun at it. But I do think that there are some interesting, like if you can use the token economics to jumpstart the network effects in some kind of a business, I think that can be interesting. You probably need like a compelling product that's better than the existing product, but then
really, consumers need a better product to replace the existing one that's solving the problem. This is the key insight. You're 30 years old and or whatever, 33, I don't know. How old are you?
30, yeah.
You're 30 and you understand this basic concept that the product you're replacing, you have to be at least 50% better for people, maybe twice as good.
Yeah,
people are not changing for a 10% better product or a product that exists in a white paper.
Yeah, so like there's been 2 that I've invested in. One's Lolly, cashback, Bitcoin cashback. The TLDR
How does
is young
that work?
people.
The consumer, tell me.
Yeah, so young people don't use the cashback products like Ebates, but Lolly gives you Bitcoin instead of like cash back. So it's interesting to people. You use that as a wedge to build up a crypto fintech product. The brands that they work with love it because young people don't use their cashback products elsewhere. So it was a really interesting kind of wedge to build in, and it all made sense. Yes. And yeah, it's crypto. And then the other one, it's a game. It's like a free to play FIFA. Like it's basically like free FIFA, like free soccer game, multiplayer first, cross platform, free to play. I invested, and he's like, oh, I can actually use some of these Web3 components to monetize, and it actually makes sense. I think it will help us grow faster too. So I was like, yeah, makes sense to me. So that's typically the crypto I'm investing in, where it's like
that, you understand the end user value proposition as opposed to some theoretical. These are going to be Rails or something that everybody's going to build everything on top of, and this is the next app store, and so it's worth $1 billion or $5 billion or $10 billion, and it's like that's a long way to go, but okay. I've been giving this some thought. This is my new theory on crypto, because the store of value I thought was like a pretty weak use case. Like store of value, like most people don't own their home, so like they should probably accomplish that task first of like own your home. It's a pretty great store of value because you can live in it.
That's true.
And you need to live somewhere, and rent is just you giving money away. But if you own your home, or maybe own a second home, whatever. So store of value I thought was there's other things you can buy that store of value, like equities in companies that have value propositions, like say Amazon or Disney or Netflix that we know are going to be here in 10 or 100 years. So store of value I didn't like. And then money transfer, I was like, are you guys actually looking at the fees and saying this is cheaper? Because I don't know, I just saw 30% in gas fees for the Constitution DAO, and we're in year 12 of crypto. Like, are you guys morons? Like, money transfer, this is a racket. They're just fleecing people. This is like, Tony Soprano is looking at the Hesh on The Sopranos is looking at the VIG at this, and he's jealous. He's like, crypto VIGs are 30%. He's getting 5% a week is his juice. And then I was like, NFTs, that actually is interesting if you own the IP. Okay, CryptoPunks you don't own the IP. Oh, but the monkey you own the IP. Okay, that's interesting. And what about royalties? Oh, you can get royalties maybe? Okay, yeah, that's actually pretty interesting. Smart contracts. Oh yeah, I could see that working because I remember, I remember music licensing. I remember photo, stock photography. Huge. Yeah, these things made money, and like there was a lot of money moving around. And like if there was a new structure in Creative Commons, and the original photographer gets 10% of every use of their photo, and then if they sell it, they get a 20% kick or whatever it is.
Yep.
I was like, well, that's really brilliant. sorry, I can't help but like it. Now, I think these NFTs are all a giant scam and that people are doing insider trading on them to paint the tape. Like there's been 20 transactions on this monkey, but it was probably just a bunch of friends trading it between each other. And then you're the 21st who buys the monkey and you're the bag holder. Like, are you guys schmucks? Do you not think this is occurring? Putting that aside, then I saw DAOs and I was like, this is smart.
So what do you like about DAOs? Like, I don't think I get the DAOs. I get NFTs.
I'll explain it.
Okay.
So you just went through putting together a venture firm. Did you use Carta, Assure, AngelList, a lawyer? Okay, use AngelList. So AngelList charges like whatever, 30, 40 grand to set these up, or you can give a percentage, right? So you're giving of your 20 points, 2 points or something. What's the deal on AngelList now?
It was $25K. I maybe got a deal because have like a Twitter following. I have no idea, but it ended up being like 0.3% kind of like admin fee, which I thought was really fair.
Great. So that exists as a concept. And so that changed venture forever because it used to be $250,000 to set up a venture firm. So now you did it for 10%. If it was $250K, how accessible would building a $10 million fund be for you? Not as accessible.
Wouldn't have been able to do it.
Wouldn't have been able to do it. Okay, great. So now you've proven my point. Now we start looking at capital formation as a genre, right? As a toolkit. Yep. And sure, we have GoFundMe. GoFundMe's work. I did a GoFundMe to report on crime, and $60,000 showed up, and I gave it to an investigative journalist, and just required a couple tweets. And they're doing Gotham by the Bay. If you Google Gotham by the Bay, you'll see a newsletter on Substack, just about crime in San Francisco. And a bunch of people donated to it. I said I'd be 1% of it, so I think I put in $600. Other people put in a couple thousand, hundreds, 50. It was pretty neat. Okay, so we have that proof point. We have you as a proof point. Okay, so now let's say we want to buy an asset. Let's say we all live in San Francisco and there's an open lot in San Francisco. It's a giant triple lot. It's going for $12 million. And I just tweet, I want to buy this $12 million thing and I want to make it into a dog run and a kids park. Anybody want to put $12 million into this? I'm starting a DAO. DAO gets fired up. They're donations. But then I say, in the programming, we're going to share the designs and everybody gets to vote on the designs. And then we're going to let anybody who donates use it for their kids' birthday parties. There'll be a reservation system. You get up to 6 hours a year in using these facilities, either the dog park for your doggy birthday or the park for your kid's birthday party or whatever you want to use it for. Okay. And we'll have a special key and a key code. The park will be available to everybody during these hours, but only to members with this key code after hours. So you can use it 24 hours a day since it's a private park. Might that be an interesting concept to fire up for close to free? If let's say it was in fact, it gets to this free and then some programmer just fills out a form. It could be like a no-code, like a Bubble or a Webflow or even Zapier or if this then that. So you go in with an if this then that statement and you're like, if you own this many tokens, you get this many hours. And then you have governance. And you can sell your tokens to other people if you leave the neighborhood. And so, boom, now we've bought this acre in San Francisco. We tweeted it. It caught viral, which is what happened with the Constitution. And you can just start thinking about every possible use case like that. Let's say we said, hey, we want to fund 5 new managers. We're going to create a fund of funds of $100 million. And we're going to just give $20 million to 5 fund managers. And we're going to all vote on which fund managers. The fund managers come before us. They give their presentation. They show their metrics. We all get to vote. And then you could sell your stake in this fund of funds to each other. How interesting would that be?
Would be interesting. I feel like there's some regulatory stuff that has to be figured out because that definitely sounds like we're 100%, skirting some
because you would have things. To be, these DAOs, these would have to be people who were accredited investors. And then if they're donating the money, they don't need to be. But if you did have a share of it, it would have to be accredited investors today. But I think what they're doing is with the DAO stuff, like they're pushing the envelope each time with these DAOs.
Yeah.
And kind of like Bitcoin, like could you ban owning Bitcoin in America today? I don't think so. Like too many politicians own it. Too many people have adopted it. Just like at a certain point, you couldn't ban Airbnb because if you were a senator or congressman, president, mayor, you would have suicide. Too many constituents call you. Yeah, it'd be political suicide. And actually, Bradley Tusk used that technique against the mayor of New York when they tried to cap the number of lifts and ride sharing.
Oh, interesting.
And when you opened your app in New York, it said, hey, the mayor, de Blasio, wants to cap the number of things. If you disagree with this, press here to email him. Click this to call his office right now. And de Blasio was like, I give up. I submit. All right. So that's what I love about DAOs. And now I do think I am looking at it saying I think it's 5% realized. And I do understand that people are looking at it saying, hey, JCal, and this is a big fight we had on All In episode 56 and a little bit in 55 when I was so pro these. They're like, this is idiotic. And I'm like, you guys are pulling up the ladder behind you.
Yeah.
This is not idiotic. You just have to imagine, squint a minute and assume like, okay, they've solved 5% of this. Now assume they've solved 60% of it, 70% of it, 80% of it. That's what's going to happen over 3, 4, 5 years. And at some point, somebody's going to just say, I want to buy the Knicks. Probably going to be me. And $6 billion is going to show up from around the world and, a bunch of funny imaginary money. And I'm going to convert it into owning the Knicks. But that's what I like about it.
It all makes sense. I think it's like we'll see, because with all these new crypto innovations or waves, I feel like the first wave of that new concept is kind of just people trying things out. There's some grifters that come in, and there's a lot of bad actors, like you kind of pointed out earlier. So I think like I'm approaching it from an investment. Like I try to be a fiduciary of my LP's capital, so I like to really understand what I'm investing in, which is maybe crazy for a VC. And then I also try to make sure that I know what's going to happen after I invest. So, so for me personally, with a lot of the crypto stuff, I'm just going a little bit slower. I'm kind of waiting to see how it all plays out. What
I'm looking for right now is a call for startups. I'm looking for like 2 or 3 developers who want to create a DAO company that builds the infrastructure of a DAO. In other words, you come to the website, you press a button, it creates a chat environment. It creates suggesting of governance. It lets people vote on the governance. It lets people see their ownership, to see the cap table, as it were, of all the shares, and allows somebody to just fire up a DAO at any time for any reason. Almost like if a GoFundMe and a DAO were combined. I want to build the platform that is the DAO of GoFundMe DAO platform, So if somebody has 2 or 3 developers, I'll put like $500K, $1 million into that, just if you build me like a pitch deck and you're credible. So that's a call for startups. Let's go through your portfolio and questions from our live audience. What's the best question we have? Go ahead and put it up on the screen. Oh, Bob G, always great questions. What data do you ask to see first when investing in a startup? What metrics are most important? Big fan. There you go. Big fan.
Wow. That's huge. Thank you. What data asks you first? It's tough. Probably retention, whatever that means, whatever kind of company it is. I think.
Why is that important?
Well, you can be growing really fast, but if you don't have a sound product, it will kind of all fall apart at some point. So I think the growth is really important, but I really care about like, okay, cool. Retention is 2%. That's a leaky bucket. Or if it's 90%, like people do not churn from your product over a certain period of time, depending on what your business model is, you can be like a cash generating machine. Like and you don't even need to raise money. So like there's kind of that spectrum that you can be on. So I really like to say like, hey, the product works really well. Typically the retention is a function of how good the product is, how the founders think about things, the team that's been hired, the market that they're competing in. Like it kind of answers a lot of those questions. So that would probably be the number one. But yeah, you always look at you look at the growth rate and like the economics, like the unit economics, the business model, like all that kind of stuff makes sense. Like average contract size or revenue per user on the consumer side. Retention is probably the number one for me.
Yeah. I mean, if you have a leaky bucket, as we say in the business, you could be acquiring customers incredibly efficiently. And then if 4 out of 5 are leaving, now your CAC's gone 5x. Okay. Tell us about your thesis of why Joker, 15-minute grocery delivery, is going to beat Uber Eats, DoorDash, Instacart, et cetera, et cetera, et cetera.
Yeah. So if you look at Joker's website, the careers page, you look at all the public information that's out there, they're really focused on Latin America. They're really not, they're smaller in the US, smaller in Europe. So they've essentially built a business that's really similar to GoPuff, but in Latin America. And when you look at these dark store vertically integrated model versus the marketplace model, the marketplaces are typically more capital efficient. You can spin them up quicker because you don't have to build the warehouses. You just partner with the local store, like local grocery stores, local convenience stores, gas station, restaurants, etc. But typically, there's two different systems that are communicating, so it's a little bit more inefficient. Since it's not all vertically integrated, it's a little bit slower. The inventory systems aren't hooked up, so oftentimes there's issues with like your order going through. The platform doesn't actually have control of the supply in the product in a lot of cases, so that flows into lower retention and sometimes less controlled growth and just like a worse customer experience. So when you go super vertically integrated, way more capital intensive, maybe you can't scale up quite as quickly, but it gives a way better customer experience. And Joker's early numbers, the traction and the retention that they have compares very well to kind of some of the other models. So, and they're mostly focused in Latin America. There's really not quite as many people doing it down there. And I think they're in New York, so they get comped against everyone else that's in New York, but that's not really their main business.
Makes sense. Yeah.
They'll still try to be in the US, just the team previously ran Food Panda, which is like the Grubhub or the DoorDash of Southeast Asia.
That.
Yeah. So it's the majority of Delivery Hero's business now by like revenue and GMV, and Delivery Hero is like a $30 billion company. So it's kind of a no-brainer. Just met the team before they launched, invested a couple times, and they're doing really well. So.
Okay, let's take another question from our audience. We'll take two more questions. Next question is from Kevin. He asked, breaking into VC question, if a 37-year-old CPA business owner was bored of accounting and wanted to break into VC, zero current network or prior industry experience, how would you do it? Very interesting.
I would start writing online, do some tweets, do some blog posts, accounting-related startup concepts. Very boring. That doesn't feel like a sexy place or a place that's very competitive. So I would have some content out there, specifically on your Twitter timeline. Make sure when somebody hits your Twitter or whatever social channel you're using, whether it's blog, whatever, the first couple things they see are all relevant and interesting to people, like how a founder can use QSBS to maximize their secondary or something. I don't know. Just like some topic.
That's a perfect example of like something that's incredibly boring, but that a large number of people would be compelled to read. I would say also, I've seen people use Quora and tons of questions come up on Quora. And so if you branded yourself the VC accountant or, the venture accountant, and you started answering questions about QSBS on something like Quora, when somebody comes to me and I see they've answered like 150 questions on Quora and I can read the actual answers, each answer might take you 15 minutes. You're making yourself smarter. So back to how Turner was able to just pull a venture fund out of the air based on this exact strategy. I mean, Quora is another great place to be active. A blog is a great place to be active. And then Rachel, who works here, had started her own podcast. And I listened to it and I was like, 7 out of 10. That's what I thought. Immediately, I just said, how good is this? It's a 7 out of 10. And I was like, 7 out of 10 for somebody out of school who just manifested a podcast out of nowhere? Like, if she's starting on second base,
that's pretty good.
Okay, that's pretty freaking impressive. Like, her podcast was better than my first 100 episodes of This Week in Startups. Like, it was in terms of production and like how refined it was. So obviously she's taking notes. Great, more than qualified to work here at This Week in Startups. Let's go. And then Henry Bellicaster famously, wowed David Sachs, and now like I think they're in like a chat room together, working on edits to make David Sachs, in his right-wing position papers even more palatable to Democrats. Like they've got some like signal room with Keith Raboy and Peter Thiel and Sachs and Henry Bellicaster is what I'm imagining, and they're making videos and memes together, like this, purple pill meme.
Okay,
that's what I think. All right, pick what's an underdog firm in your portfolio? In other words, one that's under the radar, maybe most people didn't understand when you sent it to them, that you're absolutely delighted and have strong conviction about. This is a one for you to pick an under the radar firm, a company that most people didn't understand, but that you have high conviction in.
I was uniquely just smart and proud investor, right? I guess probably the easiest answer is a company called Fastly. It's, if you've ever heard of Pinduoduo, it is now the largest e-commerce company in China by number of customers. It was founded about 6.5, 7 years ago. Grew like 100x a couple years in a row, just insane. Guy who started a similar concept in Latin America. It didn't quite pattern match the same if you're just pattern matching and you were an earlier investor in PDD in China. So, I sent it to all the early investors and was like, this is insane what he's doing. Like, it's the same thing. I think it's going to work just as well. And so I've invested a bunch of times in almost all the rounds. I had to skip one when I was raising my fund.
Can you spell the name of the company?
It is Facily. Facily is how you say
Facily. And their domain name is, I'm looking for them.
faci.ly.
They got the .ly rocking.
They do.
So they're basically Libya.
So they're an e-commerce platform for lower income consumers in Latin America. So that's the majority of people. And it's unprofitable for the Mercado Libre. They're like the Amazon of Latin America. They just can't really serve these people very well because the ticket sizes are too low. So he figured out a couple tricks to get really cheap CAC, get really cheap distribution and then logistics to serve them. And it's working pretty well. The company breaks a lot because they're growing like hyper growth and they're opening new locations and warehouses and rejiggering everything every couple months because it's just always, it's growing exponentially. But yeah, I think they're the number 2 overall downloaded app in Brazil right now.
Amazing.
And no one is really talking about them, but I'm a big fan.
Is the concept here that a group of people can buy in bulk together and then chop it up when they get the package to their house or something like that, like in terms of social commerce? Or is it just small ticket sizes and being able to figure out how to get those to people who aren't ordering $200 in grocery, they're ordering $30 in groceries?
Yeah, it's smaller ticket sizes. And typically what it is, like if I go on the app and there's like potatoes that are they're like maybe 10% cheaper than the store. But if I invite you to buy your first thing of potatoes on the app, you get a discount and so do I. So I'm incentivized to spread the word and get more people on board. And you basically buy together. And then so what they do is they eliminate a lot of middlemen. They go straight back to the suppliers. They get a better deal from the suppliers, but the suppliers make more money because the middlemen are cut out, and then the consumers get lower prices because the middlemen are cut out. And then since it's all in an app, it's like you can run an advertising business, you can target people.
Genius.
Essentially, yeah. And then what they did with on the logistics side, it's all pickup. So they do a little bit of directly to your house deliveries, but most of them they actually partner with local mom and pop stores, and people pick up their orders from the store. So you can pool 20 orders in one neighborhood just to one delivery point and drastically cut your logistics costs. And then
makes sense.
You also give some traffic to the local businesses, which they really like.
That's great. Yeah. So, you can pick this up at this essentially bodega, corner store, whatever it is. Yep. That store now, hey, maybe I need some shaving cream or deodorant or whatever, some milk, whatever I forgot to get. It's sort of like poker tournaments at casinos, which are money losers, but whoever wins the tournament then winds up playing the craps table with everybody else's money, and
they all lose it all anyways. Yeah.
So when you invest in an overseas company, do they have to be a Delaware C Corp, or have you figured out how to invest in a Brazilian company, or how do you mechanically do that? Because that does come up, right, in our line of work. And what's your advice to founders then?
Yeah, it's typically Delaware or Singapore. I've done one Luxembourg entity, one that was based in France, one that was based in Sweden. Basically just pay a lawyer to look at it and make sure it all makes sense. There's no tax implications. It costs a little bit more. But I prefer if it's in the US if possible, usually Southeast Asia and India. I think they're generally Singapore. Latin America is sometimes like Caribbean, Virgin Islands. Often it's Delaware. So I think that's kind of the best practice.
Seems like everybody's doing Delaware Corps now. We see that even Australian companies, UK companies, they get that they want to make it easy for American investors who in some cases just won't invest if it's not a US company. Okay, let's take a question from the audience. Next question is from Noah. Noah asks, why would a first-time founder be interested in being in your fund if you aren't hands-on? What is the benefit? Why would a first-time founder be interested?
It's a good question. I mean, it really depends on the context. There's some where we're a little bit more involved than others. Yeah. And it's kind of the extent of like an angel. Like if you were to have CEO of some company, like you really respect the founder, they'll help you with a couple things. They're not going to hold your hand and talk to you 2 hours a day and sit on your board. I mean, I'm kind of in the same boat. And there are a lot of founders who like really don't need a lot of help. A lot of times they just need money, or they need you to connect them with a couple people. And that's ultimately the value you provide. There's a lot of VCs that pitch this we'll add a ton of value. We'll roll up our sleeves. We'll make hundreds of introductions. And
we've got a marketing PR department. We've got an HR department. And the founders who are the most dynamic are like, I don't want a VC fund running my
exactly
my employment process, my HR department, or my PR department. Like, why would I do that?
Yeah, you want the company to build those capabilities internally. And
it's
I'm happy to
important.
I can help kind of a little bit. And, I'm happy to jump on a call. Like, there's some founders that I talk to them literally every day. Some that I talk to once a year. Like, I haven't heard from them in a long time. But I've actually noticed the founders that send consistent updates to their investors on average do a little bit better than the ones that don't. And then the ones that do like to just stay in touch and like, they'll just give me quick updates. Like, we just signed this head of sales, like so pumped and like, awesome. Like, that's cool. Like you just be responsive and they're like, hey, we're getting inbound on our...
being a friend who can give you a high five and then, maybe be a warm ear if they want to talk something through. And if there's something acute and that has to be handled and there's some fire that needs to be put out, they might ask you, can you come help me put out this fire?
Yeah.
But
and I know that I'm like, there's nothing unique about me. Like, I'm not going to like change the trajectory of your company any more than someone else could. So for me, you kind of have to be a market taker. You go out and find the people that no one else is making bets on, or you find out where you have like a different view on what they're doing. And that's ultimately how I make money as an investor is I just try to back the people that, they just need your money and they need someone to believe in them. So.
Yeah. I mean, at this early stage, it's just about filling out a $500K to $5 million round, and you're passing the hat in a lot. I mean, more and more, I'm just seeing founders in this environment do a party round. They're like, I'm not waiting for a lead. The angel investors now have realized, small seed funds have realized, if I'm going to get into the round, it's going to be before a lead has been established. Therefore, I'm going to put the 50 to 100K in now, make sure I sign my documents, make sure I wire the money. And if I happen to...
Like, I'll help you get the lead. Like, after I do that, like, I'm in and I'll make sure we get someone else on board.
Yeah, but see, it's different now. What it used to be when you were an angel, you'd say, okay, when you get a lead, let me know I'm in for 50. The lead would come in and then you put your 50 in. And there wasn't this idea that you would lose your allocation because the market is so hot and somebody's got so much money and they're $1 billion fund that they're going to take everything and say, I'll give you the $5 million, but no free rides for anybody. And so that's actually a really interesting switch, because what used to happen as an angel, you'd put in 50K, the company's burning 50K, 3 people put in 50K, the company gets 3 months of runway. And then in month 4, they're like, hey, we're going out of business.
Yeah.
And that was like happening so often 10 years ago that you're like, okay, get all your commitments together. When you have 12 months of runway, then we'll hit the fund button. But things have changed, like it's just, things are moving a lot faster. Okay, let's take a final question from our really astute audience. Turner, you okay over there?
Yeah, I'm sweating a little bit, but...
Okay, here we go. It's a big, tough question coming in for Turner Novak. Okay, Mohammed asks, why do you think tech stocks are correcting itself now? Zoom is down 50%. Any thoughts? Okay, great question. Public markets do impact private markets, obviously. They're connected in some way. So what do you think is happening in the market?
Yeah, I think the biggest thing is just interest rate expectations. You value these companies and it is a lot that goes into it, but you basically take the value in the future and you say, what's that value that they're going to create over the next 100 years? What's it worth today? And the way you do that is you discount it at whatever the interest rate is being set by the Fed. It impacts that value that you'll pay today. And when interest rates are lower, it makes the valuation higher of that future cash flow, what the business is worth. When interest rates are higher, you can essentially earn more money, taking less risk. So you would not be investing in some of these businesses. Essentially, that's kind of the easiest way to describe it in just like 1 or 2 sentences. So it's really just interest rates changing. It impacts where people want to put their money. And, people say, why would I be in Zoom? Super risky. It's a tech stock. All the value is going to come in the future, when I could instead invest in a bond from the federal government, from the Fed. Yeah, somebody just commented DCF, discounted cash flow model, is essentially how you think about that. That's
Nikola down 85%.
I mean, that was a scam. Like, that was a fraud. That's why.
Beyond Meat down 67%. Lemonade down 71%. Peloton down 72% almost. Zillow down 72%, Stitch Fix 73%, Redfin down 54% from their high. So
yeah,
it's happening right now. Twitter down 37%, Snap down 38% from their high, Lyft down 39% from high. It's happening out there right now. Obviously, the Chinese stocks are also getting crushed. Baidu down 55% from their peak. Alibaba 55% as well. Zoom 55.8%. Robinhood 58%. Although that was kind of a weird meme stock moment when they went up to whatever they went up to. So I kind of like, we'll cut that off. I kind of like when they get into meme stock territory, I just kind of cut off that high. And I just like, let's forget that happened and just, keep it in the 20 to 30, $40 billion valuation range. I do think this, people have gotten a little bit crazy with this, price to sales ratio. In other words, just valuing companies as a multiple on top of whatever their top line revenue is. And it's just a little aggressive. I think people got too aggressive with that. You do also have the pandemic stocks coming back down to earth. So Zoom and Peloton and e-commerce companies. And then China, obviously, cracking down on their startups and their big tech companies explains those. So you have to kind of double click on some of these to understand what's going on. There's interest rates that affects all the stocks because people are rotating out of tech and maybe going into safer things. But China and pandemic stocks, because you did mention Zoom, people get super enthusiastic about these things, but and Zoom is a commodity product is one thing to keep in mind. They happen to be the best version of it, but that is something I would be cautious about with Zoom is that how unique is that product? Have you used Microsoft's, have you been on a board call or any kind of call with Microsoft's Teams?
It sucks.
Yeah, it was just like, why are you changing the size of everybody's images? Like, I was in like a iPhone size and people's images are moving all around. And I was like, yeah, this isn't very good. But, Microsoft, I always judge their fourth or fifth version. Like, I remember when Microsoft Word came out, that's how old I am. And I was like, wow, this sucks compared to WordPerfect. And like WordPerfect and Lotus 1-2-3 were the standards. They were independent companies, right? And then Microsoft was like, we're going to create Microsoft Word and Excel. We're going to bundle it, call it Office, and come at us. And
it's that distribution advantage that they had.
And everybody was like, these things are dog shit, man. They're never going to compete. And sure enough, version 4 or 5 of Excel, version 4 or 5 of Microsoft Word was like, whoa, they figured it out. Like they are like this giant brontosaurus or like elephant, woolly mammoth. Like, man, they walk really slow, but when they get 5 or 6 steps and they get a little bit of momentum going, like, yeah, be careful.
They're a freight train. Well, I think of Zoom as more like Cisco. Like they got to get into the phone, the communication system.
Yes, they should they should have bought some companies at that high valuation who make the hardware, like Owl or something.
They did. They bought the call center company, right? Five9
they did.
Or something.
That's right.
What was it called?
Yeah.
Something. Yeah. You know what I'm talking about.
But I mean, they should have Zoom headsets, Zoom cameras. They did have a Zoom hardware product. They made a monitor for meetings. So they did dabble. Maybe keep pulling that string is my advice.
Yeah. Well, also, when I make the Cisco comparison, Cisco's also had a nice fall from their high. So maybe that's what Zoom's doing too.
Well, yeah, Zoom is drinking their milkshake because those Cisco rooms that big corporations had, they were about $250,000, and then they went down to $100,000 and $50,000, and now it's like nobody's going to a conference room. Everybody's in their living room or their closet, and they're just. I was on a call with a VC. Actually, I think she was on the podcast, and she had the blurred background thing, and then she unblurred it at some point, and I was like, "Are you in your walk-in closet?" She's like, "Yeah, my husband's working at home. There's 2 kids here. I just like the quietest, like back of the house." Bedroom, closet. I'm literally in a closet doing a podcast. And I was like, that is peak pandemic moment. All right, listen.
Yeah.
Turner, how can people pitch you? That's what they all want to know. So what's the best way to pitch you? Do you like to hear ideas? Do you like to see MVPs? You're a new VC, so you're probably not cynical and annoyed when people contact you. So... Or maybe you are. Are you cynical yet when people contact you? Have you written a blog post about the right way to contact you?
I have not. Yeah, I hope
that's
I never do that.
That's when you know VCs jump the shark.
Yeah,
when they start tweeting about like, please stop emailing me your ideas. And I'm just like...
I'm too busy ringing the bell.
Are you in the business investing in founders of the customer? Like, it's literally almost like clockwork. Some VC hits a unicorn back in the day. And all of a sudden they have a blog post. Here's how to contact me correctly. Your best bet is to go through somebody I know and jump a hoop. And it's like, or you could open your email and just look for 10 seconds or forward it to an associate?
That's honestly, that's probably the best channel. There's a meme that I don't respond to DMs because I just lose track of them.
They go by. They're like a river. They're just like, DMs.
You don't understand it until it happens to you when you're just like, every day you get like 100. And it's not usually not that high, but I just don't have time to respond to them all. And actually, Twitter's UI is not very good for responding to
I've been talking
DMs.
to the product manager at Twitter about this. I said, if you really want Twitter DMs to work, make a product called DMs and make it a standalone DM app as part of the paid program. Make it searchable. You know, they just added pins, so you can pin 4 conversations. Whoop-de-doo. Congratulations. But they should make a full-on dedicated app like Facebook has Messenger. There should be a Twitter DMs app. It should live and die on its own. And it should have like an in-mail function where if you're using Twitter DMs and you're paid, you can slide into people's DMs. Even if they don't have open DMs on, they could be like a third tab of like paid DMs. And really make it a robust product where, you know, DMing somebody with a cost would at least build some signal, whatever. There's just like a million different ways to monetize it. But yeah, the product sucks and searching in it sucks. The search on Twitter is amazing. People don't realize how good the semantic search on Twitter is. You could search by, you know, time period. You could search by if they're verified or not. You can search by, you know, keywords, Booleans. I mean, it's very sophisticated. And none of that made it into Twitter DMs. So if you're searching amazing for, you know, like, yeah, it's just terrible. It's terrible interface. No starring. You can't star them. Can't put them into folders. How about folders? Would that be too hard to do, Twitter? Imagine if you had Twitter DM folders and you could just be like VC, founder, journalist. And at the top, when you opened it up, it would be like VC, founder, journalist, media. And you would just go into them. What's that?
I said meme accounts.
Memes, dank memes, dank memes, 2 different ones.
Yeah.
So anyway, email works. Great job on the program today.
Thank you.
Now you're halfway through this fund, so that means there might be at some point another fund coming. Who knows?
We started to think about it. What
do you think about these rolling funds? Does that seem like a good idea to you or a bad idea to you?
Well, if you think about Tiger Global, I know you are aware of them. Their last fund they deployed in like 3 or 4 months. This next fund, I would not be surprised if they deploy it in 3 or 4 months. They are essentially a rolling fund where every quarter LPs recommit to the next quarter
tranche
or couple months. Yeah. And I think that it seems to be the direction everyone's going. Everyone is decreasing their deployment periods and they're increasing their fund sizes, which is showing up in valuations and the intensity of the market. So yeah, I try to stick to 24-month funds. I'm not trying to become an asset manager where I'm running a treadmill of like deploying as much money as possible. Our current portfolio was pretty diversified. The next one will be a little bit more concentrated. And so I've started to think about it. We're not like really fundraising. There's a lot of people that are kind of interested, but I haven't really actually figured out a game plan yet. But I'm excited about it. It'll be cool to officially.
You didn't have to go on the road for your fund. You just did it all over Zoom, right? And emails and small check sizes. People don't even want to meet. They'll probably just commit over email, right?
Yeah, it was a little bit. Like a lot of people that I'd met and like, you know, knew them for a couple of years. They're like, put me down for this. And
might be the best part of it now is just that you can just raise your fund without going on tour. Last time I went on tour, you know, I did East Coast. I'm going to Boston. I'm going to Pennselsvania. I'm just going.
You have to wear a suit and all that stuff.
I was wearing a suit and tie. Yeah. I mean, I was suited up and felt great. Felt great to wake up in a hotel and get your suit on and polish your shoes, have a proper breakfast at 7 a.m. and get over there at 8:45 for the 9 a.m. meeting.
And just get drilled.
I kind of found it, but then I kind of had you watch the show Billions at all? You're a fan of Billions?
I've seen a couple episodes, yeah.
I basically went, what's the guy's name? Axel? Bobby Axelrod? I kind of had a Bobby Axelrod moment and I was like, what am I doing? Like, this isn't me. And I was just like, I'm just going to put on an AC/DC shirt and just be like, I'm putting in my money. You want to come along for the ride? Let's go. There was just a scene where he was like, enough going and pitching everybody. And he just went punk rock. He's like, listen, the fund's going. It's my money. If you want to come along for the ride, you can come along for a ride. The end. And he just took like a more, and everybody's like, oh, no, of course, Axel, Bobby. Oh, Mr. Axelrod, of course, we're in. And some people were offended, but other people weren't. You don't need to please everybody. All right,
Yes.
listen, Turner, you were a great first appearance on the show. Will not be your last. Let's do a 6-month check-in, Nick. Can we if Mr. Novak's schedule allows, between TikTok. I also like your TikToks. What is the inspiration of this like big nose TikTok guy who's just
I don't know. I just try to think of the most ridiculous things I could do that was funny and really didn't offend anyone too much. And just, yeah, that's where it came from. I honestly, if you go on TikTok and you scroll it, you get ideas that you can borrow from the mainstream to like the VC startups. That's where I get most of my ideas from. There'll be like a funny sound or music or a different like character. Like just be like, oh,
what is that character have a name?
I think he's just like the VC. He's just like stereotypical
Nerner
VC.
Tovak.
Maybe. I don't really want to be associated with the character, even though it's me.
Which
I don't know.
My favorite was, I think is when I became aware of it, and I retweeted it or something, was he just kept interrupting the person with inane, or maybe Nerner Tovak does this every time, but it was like he kept interrupting them with inane bullshit.
Like, what's the TAM? What's the LTV
what's the
to CAC?
What's the TAM? Yeah, what's the CAC? And I was just like, okay, it's in the deck. Did you review the deck before you got here? Like,
wait, what does the company do again? What's the name of the company? Who else is investing? Wait, Sequoia? You said Sequoia's leading? You might like this one. I did one where I reviewed all of Chamath's Alphabet IPO SPACs. It was just like a year ago. But I like Open Door was like the worst. And I made up a bunch of fake ones like IHOP. He was gonna I made up some funny stuff. I don't know if you saw that.
I do remember seeing that one now.
He thought it was hilarious. So it was
pretty great.
So I try to make it funny. I think founders, like, they don't need people to give them all this advice and like tell them how to run their business. Usually they're just like, I want to get to know the people they're investing. I want to be able to trust them. You know, I think in making jokes and, you know, making memes and being humorous, like, you kind of show like, I know what I'm talking about. Like, I get it. You know, I'm not going to come in and boss you around. And usually for me, like for what I'm at, I'm not leading you around. I'm not sitting on your board. Founders just want somebody that they identify with and think they can trust and feel like they know before they reach out. Like they know what it's going to be like talking and working with me. So that's kind of what I try to portray in the tweets and the TikTok. So,
all right, everybody follow Turner Novak, TURNERNOVAK, in case you need the spelling. Yeah, search for him on Twitter, search for him on TikTok. Great follow. And we'll see you online. And in 6 months, have you back on the program. We'll do another Q&A. We'll do a little more portfolio review. And we'll see you all next time on This Week in Service. Bye-bye, everybody.